Did the Federal Reserve just tank the stock market? That's the question some folks are asking as they saw the market rallying during the first half of the day, only to be cut short by the Federal Reserve issuing not one, but two separate press releases talking about the upcoming monetary tightening. What can that mean for the economy? What can that mean for stocks in general? We'll talk about that and more. If this is your first time tuning in, my name is Daniel, and you are watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And so as I mentioned, the Federal Reserve posted not one, but two press releases. You have their typical and expected FOMC statement, effectively providing notes on their expected policies. This is this is how Jerome Powell has done it, telegraphing well in advance. This is what we're doing. This is the amount of quantitative easing that we're doing. We expect it to wrap up. This is the time frames. So this was very much in line with what was previously telegraphed. This includes ending quantitative easing by March, and that is, a quick wind down from the $120 billion a month just a few months ago to zero by the end of this first quarter 2022, and then looking at a single rate hike in March as well. So this is all very telegraphed. No shocks here. There had been some concerns that, as Bill Ackman had talked about, maybe they would raise rates faster, but that's not what you're seeing here. Sticking to the schedule, sticking to the well-telegraphed move. But in a surprise, the Fed also laid out their principles for reducing the size of the Federal Reserve balance sheet. This does get folks a little bit nervous. I mean, broadly, the principles are very open-ended and give them a lot of room to maneuver. For example, the last bullet point even pretty much calls that out as such. The committee is prepared to adjust any of the details of its approach to reducing the size of the balance sheet in light of economic and financial developments, i.e., if things start going sideways, we can just cancel this or do whatever we please about the balance sheet. That's really what they're saying. But that said, this does make folks concerned. This does, playing with the balance sheet and talking about it again does put investors on edge. I think if they had done a press release where they had just done that first press release with the typical meeting notes, that would have had, more of a calming effect. And that's partly why the market was starting to rally. We're not focused on reducing the balance sheet. This puts it front and center saying, we are very mindful that we have expanded the balance sheet to a $9 trillion balance sheet. We think that's well in excess of what it should be, and we're going to unwind that, in the quarters ahead. And so that they're playing with fire here. And just the mentioning of trimming down their balance sheet is enough to spook the market. And I think that's what's going on here. By starting to increase the risk of selling down their balance sheet, it can cause bondholders to start front-running the Federal Reserve. Here it is. They've spent literally trillions of dollars buying up various different types of bonds. And now they're saying, we're going to start selling them. This increases the risk of creating the type of generational shock Ray Dalio talks about. And I did a whole separate video about it. I'll do a quick recap here, which is that, in short, the U.S. economy is so levered now, extremely high, debt to GDP ratios, and on really a lot of different metrics, but particularly looking at the federal, the central government and how much debt we have. So any sort of change, and by the way, there's also significant deficits, continuing to go on at 5 to 10% of GDP. So not only do you have a lot of debt accrued, but you also expect, at least the government expects, to continue accruing a meaningful amount of debt in the years ahead. And so if you're going to, let's say, finance not only the existing debt, but also the upcoming deficits, finance those upcoming deficits, you're going to need to issue more debt. So not only will the central government be issuing debt, the central bank via the Federal Reserve is also saying, we might be selling some debt too. So that increases effectively the amount of obligations that people will need to buy in the quarters ahead. That does create a very real risk that all of a sudden people say, well, wait a second, all these people are going to be selling these bonds. Why don't we get in front of it and sell ours, maybe even start shorting some bonds because interest rates are so low? And this can create what Ray Dalio calls is effectively a reset or a restructuring of these debt obligations. And that, in my opinion, is a type of generational shock because people wake up and go, holy smokes. And so I'd say the thing to keep an eye on right now is what do effectively long-term interest rates look like? If you start seeing, let's say, bond rates start jacking higher, then you might have a problem. and then you do have a reset in terms of valuation. So a lot of this plays into the sentiment of the market. Nothing here from the Federal Reserve is saying, oh yeah, we're going to be aggressively doing this, but just calling this out is enough to unsettle the market. So look, in the short term, no one knows exactly how things play out. This type of language could cause the market to just get shocked. And you've seen shocks before where, you go back to October 1987, the market fell like 30% over the matter of 2-3 days. So you look at it and these types of things can happen. Would it surprise me if that happened here? Of course not. It wouldn't surprise me. But I also am very mindful of that last bullet point we saw, with the Federal Reserve saying, oh yeah, if effectively financial conditions or economic conditions change, we might change our mind. And so I would expect increased volatility, but I would also expect to see the Federal Reserve, if things were to start, let's say, dropping precipitously, for them to go out, yes, we're mindful, we're going to go super slow with any sort of unwinding that balance sheet. We're very mindful of it. And so it's a tumultuous investment environment. My view is, I'm not looking at the volatility and the tumult as an excuse to sell my underlying positions. I want to judge my positions based on the underlying fundamentals. What is the intrinsic value of this business? What's the cash flow that I think they're going to generate? What's the growth? And that's how I'm going to focus on individual companies. This does impact potential hedging that I'd consider, which I do have on. And so I am looking at this as sort of saying, I'm curious to see if this does create sort of a risk-off event for investors. We'll see. At the end of the day, no one really knows what happens in the short term with price action. And that's why folks like Warren Buffett, they're focused on I'm not going to focus on the Federal Reserve. And that's he's made that point over and over again. If the Federal Reserve told me what they're going to do tomorrow, it wouldn't change my opinion. That's how he invests, saying, look, I'm just looking for those long-term investments. I recognize they might be really volatile, but I want to pay a sensible price and just sit and hold it and judge it based on quarterly results. So it's sit, hold, but verify in the quarters ahead that they continue to execute. So anywho, if this video has been helpful for you, I do appreciate thumbs up, hit that subscribe button. Thanks so much for tuning in.